Hello everyone. Hi, my name is Professor Bhavin Gandhi and I'm a Chartered Accountant and Company Secretary by qualifications. And let me welcome you all to this JK Shah classes revision lectures. And today we are going to start with the revision of Inter-CA Financial Management. So guys, before we start with the revision, first let me discuss the paper pattern with you. As you all are aware that your financial management is paper 8 in your group 2 and which constitutes of 60 marks, and we share this particular subject with economics. And your question number 1 in your financial management is a compulsory question of 5 marks each, which can be for 4 questions. So your question number 1 will be for 20 marks, and then from your question number 2, 3, 4, 5 and 6, from your 5 questions you have to attempt any 4 questions of 10 marks each. So that will be constituting your 40 marks. So together 20 marks plus 40 marks, 60 marks will be for your FM paper. And guys, your question number 1, which is a compulsory question, this will constitute your entire practical questions, 5 marks each, no internal options available, and you have to solve all the 4 questions in your question number 1. From question number 2 to question number 6, one question can be of your theory question, and that can have sometimes internal options also, which can be anywhere between 2 marks to 4 marks, and that particular question will be entirely your theory question, which can be considered as an optional question as well, and remaining questions will be your practical questions of 10 marks each. So guys, ultimately the conclusion is what? That between question number 2 to question number 6, you have to attempt any 4 questions out of 5 of 10 marks each, and your question number 1 is your compulsory question of 20 marks. So together your FM is for 60 marks. So today we are going to start with your accounting ratios. So guys, in this revision series, the basic objective is to revise as many concepts as possible in the least possible time. So guys, you have to keep your JKSE material with you. Will not be solving any particular question, but will be definitely revising almost all the questions, covering all the concepts which are there in your book. Also, something which is important from the examination perspective or which is very much repetitive, that is also something which we are going to revise here. And guys, what are the different types of questions? What should be your strategy? All these things, my dear students, will be getting covered in this revision series. So guys, let's get started with your first chapter, that is nothing but accounting ratios. So as you all are aware that in accounting ratios, there are 3 types of questions which are possible. The first type of question is what? That they will give you financial statements and we have to calculate the ratios. So that will be your first type of the question, where P&L or income statement and balance sheet will be given to you, and then we have to calculate different types of the ratios based on the data available. The second type of the questions are where the ratios will be given to you and you have to prepare the financial statements. And guys, the third type of the questions are nothing but analysis of the different types of ratios and interpretations of the ratios. So guys, there are 3 types of questions in accounting ratios. The first type is financial statements available, calculate the ratios. Second type is ratios will be given, we have to prepare the financial statements. And third part is calculate the ratios and do analysis and interpretation. So it goes without saying, all the 3 types of questions are part of your JKSE textbook, and when at the time of revision, I'll help you to understand that which question belongs to which particular type. But guys, before we start with the practical questions, first you should be aware that what are the different types of ratios which we are going to study. So in your JKSE textbook, we have divided the total ratios into 4 main types, where the first type of ratio is called as your balance sheet ratios. Then the second type of ratios are your mixed ratios. The third type of ratios are your P&L ratios, and the fourth type of ratios are your other important ratios. So guys, all the ratios we have classified into this 4 types. So we'll be revising one by one ratio. So let's get started. First of all, as I was telling you, that the scope of this particular chapter is this 3 types of the questions which we have, and these are the ratios: balance sheet, P&L and a mixed ratio. Now why do we call a particular ratio as a balance sheet ratio? Because the numerator and the denominator both comes from your balance sheet. In your P&L ratios, obviously the numerator and denominator both will come from your P&L, and for your mixed ratio, numerator will come from your P&L and your denominator will come from your balance sheet. Okay. Now my dear students, let us talk about balance sheet ratios. Your balance sheet ratios are also known as your solvency ratios. Obviously, because when we have a look at a balance sheet, we are comparing your liabilities and assets. So that will help us to determine the solvency ratio of a particular company, and which is always calculated in pure numbers. So that's why the ratio of 2:1, 1.5:1, 3:1, something like that. So this will be your balance sheet ratios. Okay, so this will always be calculated in your pure numbers. So just be very careful that you don't attach any percentage to it. So when we are calculating current ratio, example, we'll take current assets upon current liabilities. So let's say for example your current assets is 2 lakhs, your current liability is 1 lakh, so that will be 2:1. So we are not going to attach any percentage to it. Okay. Now there are in all 7 important types of your balance sheet ratios. So sometimes, in the question they can ask you something like this as well: from the financial statements calculate the solvency ratios. So what are the different types of solvency ratios? So you should have it in your mind that these are the 7 types of balance sheet ratios and the solvency ratios, starting with number 1, your current ratio. So your current ratio is nothing but current assets upon current liabilities. And guys, this particular ratio will help you to understand that what is the short-term solvency position, right? So current ratio will be your current assets upon current liabilities. And guys, the standard ratio you have to remember will be considered as 2:1. Guys, if this ratio is tremendously high, then you can put it like this, that there is inefficiency in utilization of funds. And if suppose this ratio is lower, then we can also say that there is lack of short-term solvency with the particular company, right? So the standard ratio for this particular ratio is 2:1. Then guys, we have something which is called as quick ratio, where we are going to take quick assets upon quick liabilities. Guys, quick assets are those assets which can be immediately converted into cash without your loss of time or value. So guys, anything which can be immediately converted into cash. Let's say for example, your money which is lying in short-term investments which can be easily converted into cash, that marketable securities. So guys, there are only 2 types of your non-quick assets which we need to subtract. So from your current assets, when you exclude your stock and prepaid expenses, both of them are your non-quick assets which we eliminate. And guys, that remaining assets will be considered as your quick assets, which we need to compare it with your current liabilities. Okay. So guys, all the liabilities are to be treated as, all the current liabilities are to be treated as your quick liabilities. Sometimes bank overdraft can also be deducted from the current liabilities to arrive at quick liabilities, but we don't do that until unless specifically mentioned. So which means that your bank overdraft should also be treated as your quick liability only. Okay. So guys, when we'll be treating your current ratio, we have to take current assets minus stock minus prepaid expenses, because stock and prepaid expenses both are your non-quick assets, which we need to now eliminate from the current assets so that we get our quick assets, and we divide that by your current liabilities. Guys, the standard ratio for this is 1:1. Then guys, we have something which is called as your super quick ratio. In super quick ratio, whatever is the cash and cash equivalent readily available to meet your current liabilities, we have to take that into consideration. So guys, we have cash and bank and marketable securities, which we compare that with your current liabilities, so that we can come to know that what is the liquidity which is available with the company right now to meet your current liabilities. So cash, bank and marketable securities, those are your super quick assets, which we divided by your current liabilities. Then guys, we have the fourth ratio, which is nothing but stock to working capital ratio. closing stock upon working capital, which helps us to determine that what is the amount which is blocked in your stock in the total amount of working capital. So suppose your working capital amount is 1 lakh rupees, and in this 1 lakh the quantum of stock is 80,000. Then we put it in this words that in 1 rupee working capital, 0.8 or 80% money is being blocked in your closing stock. Okay, if this ratio is higher, then it means that the liquidity of the company is going to be lower, and lower the ratio, higher will be the liquidity of the company. So guys, this is relating to your stock to working capital ratio. If this particular ratio is lower, it means that the liquidity of the particular company is higher. If this ratio is higher, it means that the liquidity of the company is lower. Then guys, one of the most common ratios which they ask in examination is your debt equity ratio, where we are going to consider whatever is your long-term debt and we have to divide that by your shareholders' funds. So that will be treated as your debt equity ratio. Now guys, if this ratio is tremendously high, then can I say that the financial risk in the company is also tremendously high? Come on, yes or no? Yes sir. And if this ratio is low, then the risk is lower, but we advise the particular company to use the credibility and take some quantum of debt so that they can use this particular funds to generate additional returns. So in that particular case, my dear students, we have the debt equity ratio as your standard ratio 2:1, and in this particular ratio, this is also known as your financial leverage or your banker's ratio, where your debt signifies your long-term loans, and guys, your equity means your shareholders' funds. So many students get confused here, sir, how do we define your equity here? Equity means, my dear students, your shareholders' funds. It means your owner's funds. So in this particular case, we have to take into consideration your equity share capital, preference share capital, reserves and surplus, and from that we have to subtract your miscellaneous expenditure not written off. Okay, so here, though the word equity is given to you, just don't consider your equity shareholders funds. This actually signifies your shareholders funds. So guys, debt plus equity together actually gives us capital employed. Okay, so how much money is our own money plus how much money we have borrowed from outsiders, together we will get your capital employed. Suppose your debt is example 3 lakhs and your equity is example 4 lakhs, then the total capital employed in the business is nothing but 7 lakh rupees. Okay, continuing further, then we have something which is called as capital gearing ratio. Guys, this ratio is also a measurement of your financial risk only, but here in this particular ratio we are going to consider that how much funds we have generated from fixed income bearing securities, and we will divide the same with the funds generated from non-fixed income bearing securities. So guys, suppose on your balance sheet liability side, we have equity share capital, reserves and surplus, preference share capital, debentures. So out of these, you know that preference share capital 9%, debentures 10%. So there is a fixed commitment which we have to pay for your preference shareholders and your debenture holders, or else any kind of loans which is taken from the bank. The interest is already fixed. So that's why these are the funds which are going to bear some fixed commitment. Equity dividend, I hope you all know that these are nothing but your voluntary dividends, right? These are not mandatory. So these are non-fixed income bearing securities. So guys, here we just need to check that what are the funds which we are raising from the fixed income bearing securities, and we are going to divide that by non-fixed income bearing securities. It goes without saying that if you are going to raise more funds from your fixed income bearing securities, then the fixed obligation keeps on increasing, so the risk will also be higher. Okay, so guys, that's why we have debt plus preference share capital, which we need to divide it by equity shareholders funds, and your equity shareholders funds is equity share capital plus reserves and surplus minus miscellaneous expenditure not written off, because you know that these two are your fixed income bearing securities, and guys, these two are your non-fixed income bearing securities. Okay, so that's how your capital gearing ratio will be calculated. Lower the ratio, lower will be your risk. Now guys, continuing with the next ratio, which is nothing but proprietary ratio, where we have proprietor's funds upon total assets. Now guys, this ratio signifies that in the total assets of the company, what is the contribution of the proprietors or the shareholders or the owners of the particular company. So now let me put it in this words, that if suppose on your balance sheet asset side, suppose your total assets constitutes 1 lakh, and guys, we have your equity share capital, reserves and surplus, preference share capital, and out of this 1 lakh, 80,000 is being contributed by the owners of the particular company and 20,000 is contributed by the outsiders. These are nothing but debt or debenture holders. So in this particular case, the ratio will signifies that how much is the contribution of the owner in the total assets of the particular company. Guys, if this ratio is higher, it means that there is long-term stability in the particular company. If this ratio is lower, then it signifies that more money is being contributed by the outsiders in the total assets of the company. So if this ratio is higher, it means stability is higher. If this ratio is lower, it means your stability is lower. So guys, your proprietary ratio is nothing but proprietors funds upon your total assets. Now my dear students, your total assets is nothing but fixed assets plus long-term investments plus your current assets. Now my dear students, these are your 7 ratios pertaining to your balance sheet ratios or your solvency ratios. And now let us start with your mixed ratios. So guys, what happens in mixed ratio? That your numerator will come from your P&L and your denominator will come from your balance sheet. The moment you do this, it means that you are taking 2 figures with 2 different timings, because when we are considering any figure from your P&L, it means that we are considering that figure for the entire year. And guys, when we are considering any particular figure from the balance sheet, that is nothing but the figure as on a particular date. So when there is a figure which is pertaining to the entire year and we are comparing that with the figure as on a particular date, it means that there is going to be some timing difference and we need to eliminate that timing difference first. So how do we eliminate the timing difference? By taking the average in the denominator. So guys, whenever we are talking about mixed ratios, always remember that we have to take the average of your denominator. So we should have opening balance, we should have closing balance, and in the denominator we'll be taking the average, that is opening plus closing divided by 2. Example, your capital employed turnover ratio. So in that capital employed turnover ratio, we need to check how much sales is generated with the amount of the capital employed. So suppose your sales generated is 10 lakhs and your capital employed is 2 lakhs. Then this ratio is 5 times. But my dear students, while considering your capital employed, we have to take opening plus closing capital employed divided by 2. We need to consider its average, so that the timing difference gets eliminated. Now sometimes in the question they will not provide you with the opening figures. So in such situations we have to consider only closing capital employed in the denominator. So when we don't have any opening balance sheet figures available, your closing itself is to be considered as your average in the denominator. Okay. So guys, we have to eliminate the timing difference. So as you can just check here, so there exists a timing difference between numerator and denominator, and to eliminate the difference we have to take the average, which is opening plus closing divided by 2. And in the absence of information, only closing balance sheet figures should be taken. Now guys, this mixed ratios we are going to divide into 2 main sets, the first one being your turnover ratios. Now for your turnover ratios, we have to first understand your fixed asset turnover ratio. Now what will be treated as your, first of all, your fixed asset turnover ratio? It signifies that what is the sales generated with the quantum of fixed assets which has been employed. Now let's say for example there are 2 companies, and if suppose in one particular company the fixed assets is 1 lakh, in another company the fixed assets is 50,000. Now both are generating the same sales of 2 lakh rupees. So company A, company B, both are generating the sales of 2 lakh rupees. So in this particular case, what we need to do is for company A to check that how much number of times the sales is getting generated with the fixed assets which has been taken into consideration. So we will take 2 lakh, divide that by 1 lakh. So that will actually give you 2 times. And guys, when we are considering company B, we will take 2 lakhs and divide that by 50,000. So that will be considered as 4 times. So guys, we are able to generate sales twice as compared to the fixed assets which are taken into consideration, and company B is able to generate the sales 4 times as compared to the fixed assets employed. So please tell me that which particular company is efficient. Can I say company B? Because company B is able to generate more sales with lower amount of fixed assets. So that's why we always say that turnover ratio, if it is higher, it is considered better because we are efficiently doing our business. Okay, so guys, as you can just check, the first ratio is your capital employed turnover ratio, which is nothing but sales upon capital employed, right? So here we can use the average capital employed only if the opening data is available with us. So on that basis, we'll be getting the turnover ratio, and this capital employed can be in fixed assets also, and it can be in working capital also. So capital can be employed in your fixed assets as well as working capital. So when we are talking about fixed asset turnover ratio, it's nothing but sales upon fixed assets, and for working capital, it is sales upon working capital. Guys, working capital is further divided into current assets and current liabilities. Now, when we are talking about your current assets, we are talking that in how much period of time your stock or debtors gets converted into cash. So how many times the stock is rotated in the business, or how many number of times your debtors are liquidated in the business, that is something which we are going to consider in your stock turnover ratio, your debtors turnover ratio. Your creditors turnover ratio will signify that how many times in a year you have to make the payment to your creditors. So now, my dear students, let's say for example, when we are talking about stock turnover ratio, of course the formula goes like this, where we'll be taking COGS and we'll be dividing that by your average stock, and COGS signifies your sales minus GP. This will give you your COGS, which we need to divide it by average stock, which is opening stock plus closing stock, divide that by 2. So that will give you your stock turnover ratio. Now if this stock turnover ratio is higher, which means that more number of times in a year the stock is rotated, it's getting liquidated in the business, and higher the ratio, higher is the efficiency of the management. So let's say for example your stock turnover ratio is 6 times. If your stock turnover ratio is 6 times, so 6 times in a year the stock is getting rotated in the business, and it also means that the holding period of the stock is nothing but 2 months. So guys, your stock holding period, how will you calculate this thing? Your stock holding period will be nothing but 1252 or 365, and we will divide that by your stock turnover ratio. So suppose your stock turnover ratio is example 6 times, then can I say 2 months is your stock holding period? Come on, yes or no? Yes sir. And in the textbook you will find the formula of stock holding period as your average stock upon COGS into 52, 365 or 12, because whatever is your stock turnover ratio, that is nothing but COGS upon average stock. This average stock will ultimately go in the numerator, so then it will become average stock upon COGS into 52, 365 or 12. But guys, that's how your holding period can also be calculated. Similarly, my dear students, when we are talking about debtors turnover ratio, now instead of COGS, we will be taking credit sales upon average debtors plus average bills receivable. Average bill receivable only if it is given in the question we consider it, or else in almost all the questions which we have done, we have debtors in the denominator. So that's why opening debtors, if it is given to you, will be taking the average, and if not, then closing debtors will be taken into consideration. But here always remember that in the numerator we need to take your credit sales. So credit sales upon average debtors. Similarly, my dear students, when we are talking about your creditors turnover ratio, we will now take into consideration your credit purchases. So in your debtors turnover ratio, we had credit sales. Here we are going to consider credit purchases. So credit purchases upon average creditors plus your average bills payable. So that is something which will come in your denominator. Now my dear students, out of these turnover ratios, there is only creditors turnover ratio which actually should be lower the better. Because if your creditors turnover ratio is lower, it means that you are making the payment for lower number of times in a year, which means that more credit is being offered to you, so your creditors payment period is relatively higher. Okay, so my dear students, ultimately the conclusion is like this, that while understanding the turnover ratios, understand it like this, that we are having capital employed turnover ratio, which is nothing but sales upon average capital employed. Then This capital employed is divided into two main parts, fixed assets and working capital. Sales upon average fixed assets and sales upon average working capital. And guys, in the working capital, then we have to further divide it into current assets and current liabilities. Current assets will have stock and debtors, current liabilities will have creditors. With the help of stock turnover ratio, debtors turnover ratio and creditors turnover ratio, can we also calculate stock holding period, debt collection period and creditors payment period? Come on, yes or no? Yes, because your stock holding period will be nothing but 12, 52 or 365. Divide that by stock turnover ratio, we will be getting the stock holding period. Same goes with the respective debtors and creditors, where we will be dividing it by the debtors and the creditors turnover ratio. Now with this, my dear students, your turnover ratios gets completed. Now let us talk about the profitability ratios. Now while calculating profitability ratios, we have return on capital employed, which is EBIT upon average capital employed into 100. Now in this particular case, sometimes the opening figure will not be available, and in almost all the cases for your return on capital employed, we will take EBIT upon capital employed into 100. But my dear students, if they ask you, again I am repeating, only if they ask you in the question to calculate return on capital employed post tax, suppose they ask you to calculate ROC post tax, then only in that particular situation we will take EBIT into 1 minus tax and divide that by capital employed into 100. So this concept should only and only be used when we are required to calculate the return on capital employed on post tax basis, or else in all the situation we can use EBIT upon capital employed into 100. Similarly, we have return on shareholders funds, which will have the net profits after tax, because that belongs to all the shareholders of the company, which we divide that by shareholders funds into 100. Then we have return on equity or equity shareholders funds. Now always remember that whenever we are talking about return on equity, your equity means equity shareholders funds. It does not mean your debt equity pertaining to your equity. Here whenever we are talking about return on equity, your equity is nothing but equity shareholders funds. In that particular case, your debt equity had your equity as your shareholders funds. Here we are having your equity as your equity shareholders funds. So that's why please take whatever is your net profit for equity shareholders, that is something which we are going to divide by equity shareholders funds into 100. So this will give you your return on equity shareholders funds, okay, which is nothing but NPAT minus your preference dividend. Guys, then in your return on equity share capital, we will be taking net profit available for equity shareholders, which will be dividing it by equity share capital. So the difference between this particular return ratio, return on equity, and your return on equity share capital is, here we are just going to divide it by capital amount only, whereas here the word funds is used, and whenever the word funds are used, are we going to consider reserves and surplus also in that? Yes or no? Yes sir. Okay, so that is why in your third point we'll be having including your reserves and surplus, but in the fourth point we are just considering your equity share capital. And all the return ratios definitely should be higher the better. Now my dear students, let us talk about profit and loss ratios. Now in this profit and loss ratios, your first ratio, now these are very simple ratios: gross profit ratio, GP upon sales into 100, operating profit ratio. So your all the incomes and expenses before your interest will be treated as operating in nature, so we'll be taking EBIT upon sales into 100. And guys, higher this operating profit ratio, higher will be the profitability. And guys, suppose your operating profit ratio is 20%, then can I say your operating ratio will be treated as your 80%. So 1 minus operating profit ratio will give you your operating ratio. All the other ratios like admin expense ratio, selling expense ratio, we are going to take the respective expenditure, divide that by sales into 100. Net profit ratio will always have NPAT upon sales into 100. Guys, in the P&L ratios, always remember that we are going to divide everything by sales. And guys, wherever there is profits or returns, it should always be higher the better, whereas this expense ratio should be lower the better. Then guys, let us start with some other important ratios where we have EPS, a very simple ratio, net profit available for equity shareholders, divide that by equity, number of equity shares, and this should always be higher the better. Dividend per share, my dear students, this will also be whatever is your equity dividend, divide by number of equity shares. Dividend payout ratio. Now let's say for example, we have your earning per share as rupees 10 and suppose your dividend per share is, let's say for example, rupees 5. So can I say that your dividend payout is nothing but 50%? So automatically your retention will be how much? That will be 50%. So 1 minus dividend payout ratio will also give you a retention. So whenever we are talking about dividend payout ratio, we have to take into consideration the dividend per share and we are going to divide that by EPS into 100. This will actually give us your payouts. So suppose your earning per share is 10 rupees and your dividend payout is, your dividend per share is 10 rupees. So can I say your dividend payout ratio will be 100% with no retention at all. So whenever we are calculating retention, it is nothing but 1 minus payout ratio. Book value per share, we have to take into consideration equity shareholders funds, divide that by number of equity shares, and here equity shareholders funds is equity share capital plus reserves and surplus minus your miscellaneous expenditure not written off. So that will actually give you your book value per share. Guys, when we are talking about price earning ratio, this is used very frequently in the subsequent chapters as well. Your P ratio is nothing but whatever is your MPS upon EPS. So that will give you your price earning ratio. So guys, suppose your MPS is 100 rupees and suppose your EPS is 50. So can I put it in this words that your P ratio is nothing but 2 times? Come on, yes or no? Then the answer is yes. Okay. So my dear students, always remember that higher the P ratio, it indicates that the willingness for equity shareholders is definitely going to be higher. Suppose your market price per share is 100 rupees, your EPS is just 10 rupees. The equity shareholders are willing to pay 10 times more to earn 1 rupee of EPS. So this ratio higher indicates that willingness of equity shareholders to pay is relatively more. So that is why higher the ratio, higher is the willingness. And guys, with the help of the P ratio and EPS, can we also estimate the market price? Come on, yes or no? Yes. Suppose I give you the P ratio as 10 rupees and EPS as 10 rupees. So if I multiply this, can I get the market price per share, which is rupees 100? Yes or no? Yes, sir. And then my dear students, we have earning yield ratio where we are going to take into consideration EPS upon MPS. This ratio higher indicates there is more earning yield or more earning returns in terms of the investment in equity share, and always an equity shareholder will invest at market price. So that's why we divide the same with market price per share. Same goes with your dividend yield ratio, DPS upon MPS. Guys, when we talk about interest coverage ratio, preference dividend coverage ratio and debt service coverage ratio. Guys, these three are your coverage ratios. Always remember that coverage ratio should be higher the better, because more the coverage ratio indicates lesser risk. So let's say for example, there are two companies, right? A and B. A has an EBIT of 1 lakh, B has an EBIT of 10 lakhs. And guys, both of them, let's say, are paying interest of 50,000. So can I say that your company B has a higher coverage of interest on the EBIT, and higher the ratio, lesser will be the risk. So we have 10 lakh rupees to pay interest of 50,000, whereas for company A, we just have 1 lakh rupees to pay the dividends or interest of 50,000 rupees. And guys, this ratio, if it is higher, indicates that risk is going to be lower. So for your preference dividend coverage ratio, we'll take NPAT upon preference dividend. And guys, your debt service coverage ratio is an exhaustive ratio which takes into consideration NPAT plus depreciation plus amortization, because depreciation and amortization both being your non-cash expenditure, we need to add it. And guys, interest also we have to add it, because while calculating NPAT we have already subtracted the same. So we need to check what is the funds available with us to pay your equated annual installments, which constitutes of your principal as well as your interest amount. So that is why, my dear students, while calculating your debt service coverage ratio, we will take NPAT plus depreciation plus amortization plus whatever is the interest and divide that by the installment amount. If this ratio is higher, it indicates that the risk of repayment will be relatively lower. Okay. So guys, these all are the ratios, on the basis of which now we'll be revising the practical questions. So now, my dear students, let us start with the practical questions. The first one is your classwork section, question number 1. Now guys, if you have the solution set available with you, then you can just refer to it, whatever is the important part, whatever is the revision which needs to be done regarding these particular questions, we'll be discussing that in brief. See, in question number 1, we have the financial statements available, we have the balance sheet available, and these are the list of ratios. So on the basis of this financial statements, we have to calculate the ratios. So guys, this is actually belonging to your type 1 of the question, right? That we have to calculate the ratios based on the financial statements. Now such kind of questions are extremely easy because we just have to classify the details and solve it. The first ratio being current ratio. So your current ratio is current assets upon current liabilities. So let us identify the current assets in your question. We have short-term investments, stock, debtors and prepaid expenses. Can I say all of these are your current assets? And guys, in your current liabilities, we have creditors and bank overdraft. So these two are your current liabilities. So guys, the total of current assets, we divide that by current liabilities, we'll be getting the current ratio. Then guys, we have liquid ratio. Liquid ratio, also known as quick ratio. We have this as quick assets upon quick liabilities. And guys, we have just now discussed your quick assets are current assets minus stock minus prepaid expenses, because stock and prepaid both are treated as your non-quick assets, and which we need to divide by current liabilities. Okay. So current liabilities will be having your creditors and bank overdraft both. But if you want, you can also assume your bank overdraft as your non-quick liability and subtract the same, but I would not advise you to do that. We have to take into consideration all the current liabilities as your quick liabilities and solve it accordingly. Okay. So stock and your prepaid expenses, both of them are your non-quick assets, so we need to subtract the same. Okay. Then guys, stock to working capital ratio. We have this as closing stock upon working capital, which signifies that how much is going to be your money blocked in the amount of working capital in the form of stock. This ratio higher indicates lower liquidity. If this ratio is lower, it indicates higher liquidity. Okay? Now in this particular case, my dear students, your stock to working capital, how will you calculate working capital? It will be nothing but current assets minus current liabilities. So whatever in the first part you have calculated current assets and current liabilities, simply subtract it, you will be getting the working capital. When we are talking about capital gearing ratio, guys, we have to take the items from the fixed obligatory sources and we have to divide that by non-fixed obligatory sources. So guys, you can just check, there is 12% preference share capital, there is 14% debentures. So both of them are your instruments which are bearing fixed income, and we have to divide that by your equity shareholders funds, which is equity share capital plus reserves and surplus. So that's how you will be getting your capital gearing ratio. Your fixed income bearing securities, divide that by non-fixed income bearing securities. Then guys, we have something which is called as stock turnover ratio, and stock turnover ratio is nothing but your COGS upon average stock. Now my dear students, for this we should have the opening stock available, which is very well given to you in the question, that stock on 1st of April 2019 is 1,20,000 and your closing stock will come from your balance sheet asset side. How will you calculate COGS? That will be nothing but sales minus GP. Now let's further continue with your debtors turnover ratio. Your debtors turnover ratio will be credit sales upon your average debtors, and guys, your credit sales is available here, but we also have opening debtors of 40,000 and your closing debtors of your 3,60,000. So guys, that's how we'll be calculating your debtors turnover ratio. And what about the collection period? For your collection period, you can calculate this in months, days or weeks, but here no data is specified to you, so we can calculate this in days. We will take 365 and divide the same by the debtors turnover ratio to help you to understand what should be your debt collection period. Okay. So guys, that's how this particular question you have to approach it. This is belonging to your type 1. We have the data available. We just have to classify into different types of heads and calculate the ratios accordingly. Now, coming to the next question, my dear students, here from the following information, we are required to calculate these ratios: your proprietors funds, your fixed assets and your net profit ratio. Guys, we have the net working capital available, we have fixed assets to proprietors funds available, and then we have working capital turnover, we have ROE. Now, in such a situation, how should you approach? Guys, always remember that here, whenever we have fixed assets upon proprietors funds, which is 0.75. Now, this is a balance sheet ratio. As you can see, both these figures are coming from the balance sheet. We'll take 0.75:1. So for every 1 rupee of your proprietor funds, 75% gets blocked in your fixed assets. So guys, what about your balance 25%? So obviously that will be invested in your working capital, because you all know what is your basic accounting equation. We have shareholders funds plus borrowed funds, and this is equal to your fixed assets plus whatever is your long-term investments plus your working capital. So guys, when there is no data given to you, we can assume that there are no borrowed funds, there are no long-term investments, but yes, we definitely have fixed assets and working capital. So guys, your shareholders funds, which is also your proprietors funds, and there is no preference shares in this question. So it also means that there are equity shareholders funds, proprietors funds, all these things are your same. Okay. So for 1 rupee of your shareholders funds, your fixed assets money blocked is 0.75. So can I say your balance 25% is blocked in your working capital? Come on, yes or no? Yes, sir. And guys, we have the amount of working capital available, which is 12 lakhs. So we can take 12 lakh rupees here, and if your 12 lakh rupees is 0.25, then what should be your shareholders funds? You can just cross multiply it. We'll take 12 lakh into 1 divide by 0.25. So this will ultimately give you 48 lakhs. So your 48 lakhs will be your proprietors funds, and guys, your balancing 36 lakhs will definitely be your fixed assets. So guys, that's how we are supposed to calculate your proprietors funds and your fixed assets with the help of this ratio which is given to you. Okay, so you can just understand and conclude like this, that fixed assets to proprietors funds, if it is 75%, so 1 rupee of your proprietors funds, out of which 0.75 gets blocked in your fixed assets, then obviously your balance 25% or 0.25 will be forming part of your working capital. And then we can gross it up to calculate what is the amount of the total proprietors funds. Net profit ratio will always be NPAT upon sales, but here we don't have NPAT, but we definitely have ROE. So we can use ROE, and with that help we can calculate the net profits, and then we can divide that by sales. Sales, you can get it with the help of working capital turnover ratio, because your working capital turnover ratio will be sales upon working capital. So with the help of this ratio, we can get the amount of sales, and that sales we can use it for calculating your net profit ratio. Then guys, continuing with question number 3. Now this question is something which I would want you to revise even one day before your examination. We have this abridged balance sheet of Alpha, where we have share capital. If no information is given, this is nothing but your equity share capital. We have P&L account, we have current liabilities. On the asset side, we have land and building, plant and machinery, less depreciation, stock, debtors and bank. Guys, here we are required to prepare the trading and profit and loss account and the balance sheet. Okay, so guys, we have to prepare trading and profit and loss account and the balance sheet, which means that now the set of ratios will be available. With the help of that, we have to prepare the financial statements, which means that now this will become your type 2 of questions. Okay, now in this case, how will you approach it? So always remember that whenever we have the questions where we have to prepare the financial statements, first step is you prepare the face of your trading P&L and balance sheet. It means what? That according to you, which all items are going to come in your trading profit and loss account and your balance sheet, you should first make a note of that. So as you all know that in this particular question, we have land and building, then we have plant and machinery, then we have current assets in which there is stock, debtors, cash. On the current liability side, we have equity share capital. Then guys, we have reserves and surplus. This total will give you equity shareholders funds. Then we have some loans or debt available. Then if there is any current liabilities. So guys, we have to first prepare the face of your trading P&L account and the balance sheet. And then we have to start with the figures which are readily available. Now, as you can just check in this particular question, they have told you that the company went into reorganization with share capital remaining the same. So guys, we know that the share capital is going to remain the same. This share capital is nothing but your 1 lakh rupees. So we can first start with share capital 1 lakh rupees. And guys, what is the component? Share capital is 50%. So guys, your share capital is 50% component of the total liability side, which means that immediately in the first step itself, you know that what is the total of your liabilities. Can I say 50% is 1 lakh? obviously your 100% will become your 2 lakh rupees. So we have the total of the liabilities available, and then we just need to take into consideration the other data available, like other shareholders funds is 15%. So out of 2 lakh, if we consider 15%, so this will be 30,000. So guys, accordingly we have to solve it further and then complete your balance sheet. But it's very important for you to first start with the face of your trading P&L and balance sheet. Write down the components which according to you are going to come in your trading P&L and the balance sheet, and start with the figures which are readily available. Okay, so on that basis we'll be completing the trading P&L and the balance sheet. Now in this particular question, as you can just check, there is 5% debentures. So earlier debentures were not there, now the debentures are issued, so definitely the interest component will also come in the P&L account. And they have told you that the debentures were issued on 1st of April, which means that we have to consider the interest on per annum basis. Then guys, we have land and buildings remaining unchanged. So again this particular figure is available. An additional plant and machinery has been further bought, and a further 5,000 depreciation has been written off. And guys, the total of fixed assets then constituted 60% of total fixed assets and current assets. So this adjustment, I would just like to present it to you like this, that we have 2 lakh rupees as your total of assets also, correct? Because your total of liabilities here has to match with your total of assets. Here we have the total of assets as 2 lakhs, which is going to have two components, which is nothing but fixed assets and your current assets. And they have told you that fixed assets will constitute how much percentage? It will constitute 60%, right? So your fixed assets will constitute 60%. So obviously your current assets will be 40. So this will be your 1,20,000 and your current assets will be 80,000. Then guys, with this 1,20,000, we are going to divide this into two main parts, because there are two types of fixed assets. We have land and building, and then we have plant and machinery. So guys, the more you try and break the figures, it will be much more better for you to present it in your balance sheet. Now in this they have told you that the land and building is going to remain unchanged. So this 80,000 will continue as it is, which means that now your net plant and machinery is 40,000 rupees. So guys, this net amount in the new balance sheet will be 40,000 rupees, and then accordingly we have to do the calculation. And if you want to just check how this 40,000 has come, so we will be having gross less whatever is your depreciation, and this will give you the net amount. Your net amount is 40,000, my dear students. And guys, for depreciation they have told that opening depreciation is 15,000 and a further 5,000 depreciation has been charged. So this will now become 20,000. So guys, your gross amount will become 60. So my dear students, now what is the meaning of this? That earlier there was plant and machinery of 50,000. Now the plant and machinery is becoming 60,000, which means that during the year, have we done any addition to the plant and machinery? Yes or no? Yes, amounting to rupees 10,000, which you can just check here, that there is some additional plant and machinery which has been further bought. So that's how it gets proved that there is some increase in the plant and machinery as well. Okay. Then guys, we have working capital ratio available, which means we have current assets upon current liabilities. Then we have quick asset ratio. Very easy, my dear students. Receivables to sales ratio revealed a credit period of 2 months. So guys, now we have debt collection period available, and they have told you that this debt collection period will have closing debtors upon your credit sales, and which is nothing but your 2 months. So with the help of this, we can also get what is going to be the amount of debtors. And guys, there are no cash sales, and 4/5 of your debtors, 4/5 of your quick assets will be considered as your debtors. So the moment you have your quick assets available, so from that quick assets we have to take 4/5 part, and that will be forming part of your debtors. So 4/5 of your quick assets will be treated as your closing debtors, and with the help of the closing debtors and your credit sales, with the help of your closing debtors and your debt collection period, we will be getting the amount of the credit sales. So that's how we have to calculate for your debt collection period. Return on net worth, your net worth here means your equity shareholders funds. There are no preference shares in this particular question. Whatever is your net worth, you multiply that by 10%, we'll be getting the net profit for equity shareholders. Then my dear students, we are having gross profit ratio, which is at the rate of 15% of the selling price. So that will help you to actually calculate your COGS, and then you can just reconfirm and check whether your stock turnover ratio, etc. is getting matched or not. So with this, my dear students, now your question number 3 also gets completed. Now let's start with question number 4. Question number 4, again a very easy question where we just have to, calculate your net profit margin, return on assets, asset turnover ratio, and return on owner's equity. So guys, all these ratios, with the help of the figures which are given to you, we just have to calculate these ratios. Guys, in this particular question, you can just check that the total assets are 8 lakhs and 50% is being financed by borrowed capital. So guys, obviously 4 lakhs is from your debt and 4 lakhs is from your equity. Then my dear students, the direct costs are estimated to be 4,80,000 and all the other operating expenses are estimated to be rupees 80,000. So guys, we have whatever is your sales, we subtract operating expenses, we'll be getting your EBIT, then we'll be subtracting your interest, we'll be getting EBT, subtract your tax, etc. So my dear students, first step is to prepare the income statement and then we just have to apply the formulas. As you all know, your net profit margin, we can take NPAT upon sales. Your return on assets, we can take NPAT upon sales, or else we can also take EBIT post tax into 1 minus tax upon whatever is the total assets into 100. Guys, your asset turnover ratio will be sales upon total asset, and your return on owner's equity or equity shareholders funds will be nothing but net profit for equity shareholders, divide that by equity shareholders funds into 100. Now my dear students, your question number 5 is also one of the questions which I would like you to revise one day before your examination. So guys, in this particular question, we have to now prepare the financial statements. So guys, we have the ratios available and with the help of the ratios, we have to prepare financial statements. Here, the terminology of work cost will be treated as your factory cost, obviously, but as you all are aware that this will be nothing but your COGS. So in this particular question, we have to prepare the breakup of cost by taking raw material consumed, direct wages, whatever is the manufacturing or factory overheads, the total will give you your factory cost. And because this is an existing company and we don't have any information regarding your opening stock available, your opening and closing will be your same, which means that your factory cost itself will become your COGS. So first step is we have to calculate the sales, from which we have to subtract your GP margin. We'll be getting the amount of COGS or the work cost, and with the help of the work cost, we have to multiply this by 20% to get the amount of the raw material consumed. Whatever is your work cost, we multiply that by 10%, we'll be getting the direct wages. And guys, now 30% is raw material consumed and direct wages. So what will be the balance 70%? So that will be treated as your manufacturing expenses or your factory overheads. And then my dear students, with the help of this, you can prepare your trading and profit and loss account. And we can have to raw material consumed, to direct wages, to manufacturing or factory overheads, which is missing in this question, but that is nothing but 70% of the work cost. And then we are going to have by sales to GP. Your GP will be brought down, and then other types of expenses will be debited in the P&L account to get your net profits. So in this particular question, we just have your fixed assets amounting to rupees 26 lakhs, and with the help of this 26 lakhs, we have to first start with the fixed assets to sales. We have to start with fixed assets to current assets and first try to identify the items of the balance sheet, and you can just find out the figures which you can directly calculate with the help of the fixed assets. And then my dear students, the moment we have the balance sheet available, we have the fixed assets, we have the working capital, and then current assets total, current liabilities total, etc. Then we can calculate your works cost. So your sales is available with the help of your fixed assets. From that we are going to subtract the GP. We'll be getting the COGS or the work cost in this particular question, and that works cost will be multiplied by 20%, 10% and the balancing 70% to get the other items in the trading profit and loss account. So this question also, my dear students, I want you to revise one day before the examination, and here the important concept was the interpretation of this work cost. Okay. Then guys, you can also value your stock of finished goods, which is nothing but 6% of the work cost, which will appear on your balance sheet asset side in the current asset component, and you can avoid writing down that in your trading account credit side because your opening and closing stock is the same. So even if you write down, the figures are going to be the same by closing stock of finished goods, and on the debit side there will be 2 opening stock of finished goods, and both the figures are going to remain the same. Similarly, when we are talking about your raw material stock, then that will also be forming part of your current assets. but it will not be forming part of your trading account, because there we are going to write down 2 raw material consumed, which will be opening plus purchase less closing. So that's going to be your comprehensive figure. Okay. Now, after this, my dear students, in question number 6, we are required to calculate the operating expenses, and then we are required to prepare the balance sheet. So guys, we have sales, return on net worth, rate of income tax, share capital to reserve, current ratio, etc. Now this is a very important question. Again, you should revise this one day before the examination, and this was also asked in your July 21 paper, where we have the data available and we are required to calculate your operating expenses and also prepare the balance sheet in the following format. Guys, whenever such kind of your format is available, then we are very lucky. We just have to substitute the figures here and we already have the face of the balance sheet readily available. But guys, your operating expenses, how will you calculate the same? So guys, in this particular case, we have sales. From this, we'll subtract COGS, we'll be getting GP, we'll be subtracting the operating expenses, we'll be getting the EBIT, from which we'll be subtracting interest, we'll be getting EBT, and then we'll subtract tax, we'll be having NPAT. So my dear students, here we have sales available, we have COGS available, but guys, with the help of the net profit ratio, first we'll calculate the NPAT and then go reverse to calculate the amount of your operating expenses. Okay, so quite manageable, but the only thing is that how should you approach to prepare your income statement and then start with your sales, the figures which are readily available, you can substitute that, and then once we have the sales and the net profit ratio, we also have the NPAT, we can go reverse and then we can calculate the operating expenses. Okay. Guys, continuing further, in question number 7, we are just required to prepare the summarized balance sheet and we have the data available. Again, the same concept, we have fixed assets to proprietors funds. So here we are going to use the balancing 25% as your investment in working capital, and with the help of this, we'll be preparing the balance sheet. So quite manageable, question number 7. Then my dear students, question number 8 also, we are required to prepare the balance sheet and we have the data available, and with the help of this particular data, we are going to prepare the balance sheet. We'll be valuing stock, debtors on the basis of the sales, and then we are having current debt, total debt. So we'll be having your long-term debt also in this particular question, because in this question there is current debt to total debt which is 0.4, right? So what does it mean, my dear students, that out of the total debt, 40% is your current debt. So obviously your balance 60% will be treated as your non-current or your long-term debt. Then my dear students, we have question number 9. This question also you can refer one day before the examination, where we are required to calculate the ratios. Okay, and these ratios are to be calculated for both the years, because we also have to give reasons for the change in the ratios for both the years. So guys, we have to comment on certain things as well, that what is the GP ratio for 2019 as well as 2020, and then we need to check that what is the difference, why there is a difference, what is the reason behind the change. So we have to write down some analysis which indicates, now this is going to be your third type of the question, where we have to give reasoning and analysis that why there is a difference in the ratios between the 2 years. Okay guys, in this particular question, some of the ratios which are very easy: gross profit ratio, GP upon sales, operating expense to sales. Then we have operating profit ratio, which is EBIT upon sales into 100. Your capital turnover ratio is going to be your sales upon your capital employed. But guys, here you have to remember that in both the years we are going to take closing capital employed only, because your first year opening capital employed is not available. So we'll be dividing the sales by closing capital employed. In second year, though there is opening available, but we are going to divide that by closing capital employed only. Now for stock turnover ratio, we already have your opening stock available as 40,000. So guys, we have opening stock for the first year available. So are we going to use average for the first year? Yes or no? Yes sir. And similarly, we are also going to use the average for the second year, because we have the opening stock available for the first year. So guys, for your stock turnover ratio, we have to take COGS upon average stock, which will be opening plus closing divided by 2, and for both the years we have the opening stock available. Then guys, we have net profit to net worth. And then guys, while calculating debt collection period, here also my dear students, we don't have the opening debtors available for the first year, so we will be using closing debtors only. And similarly for the second year also, we'll be using closing debtors. So your argument can be like this, that sir, for the second year at least we can use average because we have the opening debtors available, but the answer is no, because here we have to do the comparison. So that's why the ratio should be calculated in one specific way only, that is called as standard measures of comparison. So that is why we're going to take closing debtors for both the years to calculate your debtors collection period. Okay, so guys, then we have to just calculate the ratios, and on the basis of which we are going to comment. In these ratios you can see that in the second year the return on capital employed is getting lower, and that is because there are some inefficiencies which you will find while solving the question. The turnover ratios are decreasing, and decrease in turnover ratios, my dear students, which indicates that the management is inefficient. Okay, so this is one of the question which I just want you to go through it once. And then, my dear students, we have question number 10, which deals with your calculation of some other important ratios, right? Now here also, my dear students, the first step is we are required to prepare your income statement, where we will be starting with sales minus whatever is the cost. But here, my dear students, we don't have to start with sales. We have net profits after tax available, which is 2,70,000. We'll just go reverse and we'll calculate what is nothing but your EBIT available. Let us just check that which all details are available. See, from net profits after tax, if we subtract your preference dividend, we'll be getting your net profit for equity shareholders, and then we'll be subtracting equity dividend, we'll be getting your retained earnings, right? Now in this particular question, we are required to calculate your dividend yield. So dividend yield will now become your returns, right? Yield is one kind of returns on the market price. So it will be DPS upon MPS. What is the cover for preference dividend? So your preference dividend is always paid from your NPAT. So we have to take NPAT upon preference dividend. What is the cover for equity dividend? So we have to take net profit for equity shareholders, divide that by equity dividend. Then we have earning per share, which is net profit for equity shareholders, divide by number of equity shares. And guys, P ratio is MPS upon EPS, and the MPS is available as 40 rupees. So with this, my dear students, your accounting ratios is now getting completed from the revision perspective. Just go through the questions, my dear students, once more, and one day before the exam I have told you that which all questions you all need to just check it. So just go through that once, okay? And that's it from my end regarding your accounting ratios. I hope that we have covered maximum ratios in the least possible time and completed the revision of almost all the classwork section. So thank you so much.